then we had a really good webinar on Tuesday night. If you go to our website, but it was Clint Coons really kind of talking about some very new and creative ways of doing asset protection. Instead of our normal, let's use a holding company, he's using statutory Wyoming trusts. And I think it's going to revolutionize the industry, but for right now, we're going to kind of stay away from that and just answer questions about what we normally do. So Kendall, we've got a bunch of questions coming in.
You're popular, Don. It's a good thing.
Well, we're going to try to answer what we can in a half an hour. We don't want to take your whole lunch hour. We get to as many as we can in a half an hour, and we'll go fast.
Why not? Have a bottle of water with us.
There we go. Water with Don.
Water with Don. All right, we're changing the name. Water with Don. All right. In the handbook, FLP set up in the states with good charging order is often used to hold safe and dangerous assets separately. So we talked about, Anderson seems to recommend using Wyoming or Nevada LLCs with strong charging order protection and anonymity to hold assets. Are there any major differences when it comes to asset protection using FLP versus LLC versus, say, Wyoming or Nevada?
Okay, so we've written the asset protection handbook, whether you have it or not, but we very strong, all the 18 different case studies in there. We're showing a majority of family limited partnerships. We'll use exclusively LLCs whenever there's real estate involved, but when there's safe assets like brokerage accounts, bank accounts, we still prefer family limited partnerships. Now, let me clarify that. That's a limited partnership. Your state is not going to know what a family limited partnership is. It's just semantics. It's a limited partnership owned by family members. We prefer them because of the long court experience. The state, there are sometimes, like California will tax limited partnerships less than LLCs. So Anderson will prefer that. Sometimes states will tax them differently. I know Florida taxes limited partnerships less differently than LLCs. In Florida, almost exclusively, even for safe assets, we would use an LLC. California, the reverse is true. So, but if everything is equal, we still like the longevity of 100+ years of court experience of a limited partnership. Anderson feels a little bit different about that. They like to use a lot of LLCs, almost exclusively, unless there's a really good reason for it. And you'll see that there's often a difference of opinion between us and Anderson, but we look at a lot of different law firms in addition to Anderson and see what they're doing. We try to follow, but then we also rely on we don't want our students to be a guinea pig. We like long-tested, really good asset protection that has a lot of court experience. So is it like 49, 51%? Well, it could go either way. Yeah, it often is. And sometimes it's not a big difference whether you use a limited partnership and an LLC. Sometimes it is, because the taxes will be different, the state statutes will be different. Sometimes it's 6 dozen of one, half dozen of another. Sometimes it doesn't matter. I think I really messed up that analogy, but anyway.
It's good. You talked about, so that's the LLC versus FLP, court history and case law, but what about Wyoming versus Nevada versus, say, California or Texas, right?
Oh, this is where it gets a little bit more complicated. Sometimes we have to put the assets in the state where the property is held. And we will use a Wyoming or a Nevada holding company to own that asset. But we don't hold it outright. Let's say we've got a property in Indiana. I'm not going to hold that directly in a Wyoming entity because I want I want standing in the state. I want to be able to enforce contracts and evict tenants, and I want to be able to defend myself in court. So I want a local entity so that I've got standing. Now that could be held by Wyoming, Nevada, Delaware. That's when I would use a state with stronger charging order protective. If somebody's coming after you, then they've got to fight you in Alaska or Wyoming or Nevada. But to hold the assets themselves, we'd like you to have standing in the state. So, I don't know, that's...
In some states that better, yeah, they're commenting about Wyoming being so much stronger, Nevada being so much stronger. Clint covered that this last week quite a bit.
He did in our Tuesday night webinar, so watch that. But that's, but the question of jurisdiction will always come up, and it's not complicated. The assets should be, if you've got real estate, should be held in a local jurisdiction, whatever state you're in. Kentucky property, hold it in Kentucky LLC. Now that could be held either by you or a stronger, and that's why we like hub entities or holding companies, because the charging order is a lot stronger. Texas, it depends. Texas has really good laws for multi-member LLCs. So does Florida. So holding companies could be there, but now we look at the filing fee, and Wyoming is only $50. Oh, gosh, that could be substantially lower than what you're doing. And it's kind of a case-by-case thing, but there are some basic rules we use to cover everything. And once you understand those rules, it's really it's kind of a cakewalk to help people sometimes. Anyway.
Well, and Marin just walked in here and reminded everybody, reminded us, and I just saw ECAT jumped on here, says she's going to be, she missed Tuesday night webinar. I know you're coming to the summit, but remind everybody, if you don't mind, ECAT, let us know, share, turn on notifications. So if you're on Facebook, you want notifications for future events, make sure to go to our Facebook page, Protect Wealth Academy. So it's facebook.com/Protect Wealth Academy. Make sure you turn on notifications from us, and you'll get updates every week. The summit notifications, you'll get this one, Water with Dawn. Is that what we're changing it to?
Whatever. So, the Facebook page, Protect Wealth.
Protect Wealth Academy. So facebook.com/Protect Wealth Academy. Everybody on here now is seeing that, but we'll post event updates on here regularly.
And we're okay if you share that with other people. We kind of like that. And so,
yeah. All right. So
next
question. All right. Corporations don't normally provide anonymity. Okay. So I have been managing a rental property by myself. Current tenants know who I am and where I live. Yeah, that's tricky. If I use my C Corp to manage the rental property, who is actually going to conduct the day-to-day management? Okay. So who is actually going to conduct the day-to-day management activities? That's tricky. So how do you have anonymity if you're the one doing all the work? Ugh.
Okay. So I'm gonna. Okay. Sorry. Up on top of my desk, I keep a lot of hats. And sometimes, okay, so when you're having your annual shareholder meeting, you're going to wear your shareholder cap and act as a shareholder. Then you're going to take it off and probably never ever use that corporate shareholder meeting. You're never going to act as a shareholder except at that meeting. And then there are officers and directors. And you can be the president, you could be the vice president, you could be... Sometimes in life you wear different hats. When you're acting, let's say you're managing your own properties, Jesse, and you're acting either as an employee or you're acting as an officer of the company. You're the president, you're the vice president. You can, on your card, on your business card, you say, here's the management company, and it gives you your name. You don't have to list the office. But that's really what you're doing. Whenever you're signing a management agreement, somebody's renting from you, you're always acting as the president of the corporation. And so whenever you're acting, you always list your name, comma, your title, comma, and the company name. You're never acting as Jesse. You're always acting in a corporate facility, corporate name, title, I've used the example for years. Bill Gates wouldn't sign a document. Bill Gates, it would be Bill Gates, whatever his title is, president, CEO, whatever his title is, and then Microsoft. So you're doing the same thing whenever you're signing a document, and it could be agent. Let's say you want anonymity. You mentioned you've been managing the same properties for years. But when you get, and maybe your anonymity is messed up, but not as the agent of the corporation. That's irrelevant. What we're trying to hide is who owns the property. You're managing the company. This is my management company. I manage lots of different properties. That's very different than who the owner is, because we want to direct all of the liability up to the management company that owns a desk, a chair, a pencil. I mean, there's nothing there. We want to protect the owner, and not disclosing who owns the property is all I'm doing is I'm managing the property, and who owns it is none of your darn business.
Yeah, it's tricky because Don and I have owned some rentals, and I own some rentals, and it's tricky because when someone literally asks you, you have your tenant ask you, "Oh, hey, you're the one signing the rental agreement. Oh, hey, you're the one collecting rent. So do you own the property?" How do you answer that question?
Well, you avoid the question and say, "No, I simply manage the property."
Right. I mean, you literally say, if you say, literally your LLC owns a property, XYZ LLC owns a property, you can really legally, technically say, "No, I don't own the property."
No, it's owned by an LLC. Because you don't own the property. I'm not encouraging you to lie to people.
It's not lying, it's legit.
But I personally don't own the property. I manage a corporation. I work for a corporation that manages properties. This is what I do.
And that's true.
And that's true.
Yeah.
And that's really all they need to know, because the relationship between renter and management company, that's the relationship. And who's the behind-the-scenes owner? You don't have to tell them that.
And that makes sense. Like for maybe some properties you have locally, you manage them yourself. But if you have them, like say in Indianapolis, like we've done in the past, it's nice to have a management company. It really is nice.
Yep.
Especially for self-directed IRAs and SEP IRAs, things like that, where you have to.
Yep. Hope that answers your question, Jesse.
Okay, if I change my LLC from taxed from an S to a C corporation, okay, so LLC taxed as an S or a C. Some people don't know you can do that. So a corporation, it can be taxed and elected to be taxed as an S or a C, right?
Yep.
But if I change it from an S to a C, do I have to follow the same corporation formality and maintenance meetings, resolution requirements, that sort of thing?
Oh, it's a good question. Okay, so keep in mind that there's corporations require a lot of corporate formalities. Minutes, shareholder meeting, okay, shareholder meeting, and then a board of directors meeting. Yep, you got to have that annually. LLCs don't require that. You've got to have meetings, minutes at those. It could be on a scrap of paper, it could be formal, it could be, but they have to be there for the corporation. You should have a stock ledger. You should issue stock certificates, resolutions every time you make corporate decisions. Those things are important. Bylaws, appointing the president, the vice president, secretary, treasurer. Those things are important for corporations. And if you don't do those, the corporate veil becomes weaker and weaker and weaker until you don't have a corporate veil. On an LLC, those things are not required for asset protection. They can't pierce the corporate veil of your LLC because you didn't keep your shareholders meeting, because there are no shareholders in an LLC. There's only members. But for a tax side, that's very, very different than the asset protection side. So corporate formalities, other than keeping a separate bank account, paying your filing fees, if there's a tax return, don't commingle funds. Those things are what's required in an LLC on an asset protection side. But the tax side is very, very different. On the tax side, You probably, if you're going to have a C corporation, you need, inside of the corporation, you need to adopt the resolution that here's Section 105 of the Internal Revenue Code, and here's an employee reimbursement plan for medical expenses. Those things, although not required on the asset protection side, will be required. There ought to be something in there that says we agree to reimburse mileage or education expenses up to a certain amount, or those things, although not required, that nobody can pierce the veil. On the tax side, whatever is required by your CPA for a C corporation ought to be required on the tax side, for an LLC taxed as a C corp. Same thing with an S corp. So very different. Separate in your mind, here's what's required by the legal side to pierce the corporate veil, and here's what the IRS is going to require. If the IRS requires you to have resolutions in your corporate document somewhere, if you only get this deduction if it's in your board meetings, then put it in.
Interesting.
Does that make sense?
Yeah, so in the eyes of the IRS, when you have an LLC taxed as a corporation, it's a corporation.
Correct.
Which is kind of neat. So it's a hybrid. It's very flexible. But in the eyes of the, state court history case law, it is an LLC with charging order protection.
Very, very different standards between what the court will rip apart because you didn't have corporate formalities from what the IRS will. Different standards.
So if I'm a really, really good attorney and I want to attack your LLC and you did not keep formalities like the corporation suggests versus the LLC, is there an argument there at all?
Yeah, there is. They're saying, look, this is just an alter ego of you. You're not playing by the game. And so when in doubt, keep your minutes, have an annual meeting, or have at least, Kendall and I have meetings every week, and we keep records of what's going on. Keep your minutes, and again, it doesn't have to be formal, but they need to be there, and they need to be in writing. Whatever's required, when in doubt, keep your corporate formalities. Now, our LLCs that Kendall and I own together don't have shareholder meetings. We don't have board of directors meetings, but we have enough meetings and we keep records of them we keep separate books. We have separate tax returns. All of our entities are structured so that I think either on the tax or the legal side would be covered.
See, that's great. So you want to do as much as you can to have evidence proving you're using them separately, properly as much as possible. So either way, you're covered. I love that.
Correct.
That's
correct.
Really, really cool. All right. Here's another good question. So is mortgage interest deductible? That's a great one. So mortgage interest deductible, yes, if in the name of an individual, single member LLC or living trust. So is that true? And capital gain exclusion. So this going to owning your own home for the mortgage interest.
Okay, so what we're saying is if I put my personal residence in a family limited partnership or a single member LLC or whatever, can I still deduct the mortgage interest and am I going to screw up my capital gains? And keep in mind that they are very, very different. The standards are different. Kendall, if you wanted me to, you'd lose your job because, whatever.
Oh, we know why.
You work for it. We're partners. Okay, but all of a sudden, you decided to pay my mortgage for the next year. You're paying the mortgage. But I'm obligated to pay the mortgage, but you're paying it. So the question is the mortgage interest deduction, does that go to you or does it come to me?
Totally me.
And you're right. It would be to you because you're paying it. Even though you're not obligated to, you get the mortgage interest because you... So, if we put our home, let's say, in a limited partnership or an LLC that requires a tax return, it's not a disregarded invisible entity, whoever pays that mortgage gets the mortgage interest deduction. Ownership is not part of the equation. Now, capital gains is very, very different. The two requirements for capital gains is it needs to be in your name or the name of a disregarded entity, and you need to live in it 2 out of the last 5 years. Then you've got the exclusion of either $250,000, $500,000, depending on if you're married or single. That's important to understand. But the standard for mortgage interest is very different. Mortgage interest. So let's go back to your question. Let's say I move my home into a family limited partnership and it's been there 5, 10 years. Can I deduct the mortgage interest? We believe very strongly, yes, you can. Will I lose the capital gain exclusion if it's been there longer than 3 years? The answer is yes, you will.
That's across the board, right?
Across the board,
Yeah.
we don't say any way that you're going to avoid the capital gain. Now, you also need to understand there's a very big difference between a disregarded entity and a pass-through entity. Disregarded is like a single member LLC. It's like a revocable living trust. The IRS doesn't care that it exists. It's an invisible entity. They look straight through it and they see you as all taxable consequences flow through to you. It's an invisible entity. That's disregarded. There's another thing that's called a pass-through entity. This would be taxed as a partnership or as an S corp, where the taxable event stops here. They're going to have to file, the entity is going to have to file a tax return, and then it passes through to you. But first of all, the tax consequence hits here. Now that's important because if I owned my home in a single member LLC, that's an invisible entity, capital gains and mortgage interest still open to you because this is an invisible entity. But if it's a pass-through, it stops here and then it goes to you.
Interesting.
That's different. And in a pass-through entity, mortgage interest, yes, I can still claim that if you're paying it. All the improvements to the home, anything that's tax deductible. But if it's a pass-through, I'm going to lose at least the capital gain.
What are pass-through entities?
Pass-through would be S corporations and partnerships. Okay? Hopefully that makes sense. Hopefully we didn't complicate that too much.
That's great, and we cover some of that in the handbook, and sometimes we have actually a lot of videos on that, protecting your personal residence, because that's your personal home.
Yep.
These are the issues that come up, and that's a difficult one.
Yep.
All right, Marie, you asked a good question here. This is a new-to-you real estate investment situation. The owner of the house is deceased and is in pre-foreclosure.
Okay.
The estate is out of money and cannot afford to sell the home, right? So there's no equity, needs some work.
So it's not that they can't afford to sell the home, they can't afford to catch up the mortgage payments.
Pretty much, there's no equity, it needs some work, so they really don't have money to pay to get it out of the...
Okay.
Yeah.
Got it.
I've offered a sub-2 arrangement, but with it already being probate, does that change the process?
No, you can still, if you've got the authority, if you're the trustee or the executor, you can still sell the home. The very first home that I bought to flip was 3 months behind, and they were going into foreclosure here in a week, and I bought it kind of sight unseen. I caught up the mortgage payments and purchased the home, and they avoided the homeowner avoided the process of foreclosure because the home wasn't in their name anymore, and I'd caught up the mortgage payments. So what I would suggest on this is you get a really good real estate attorney. It's going to cost you maybe $1,000 to walk through this process. I know the estate's out of money. I heard that, but do it right. And if it's in the middle of probate, depending on the state, it could complicate it. I don't know enough about your state situation and how far into the probate process you are, but it seems like the executor or the trustee would always, the mortgage company would always welcome a sale rather than a foreclosure. So if you can sell the thing, catch up the payments, have the new owner catch up the payments, Seems to me like that would be the ideal situation, but I wouldn't do it without the use of a real estate attorney
Yeah.
local.
There's some gotchas in that estate sometimes. In the
Yeah.
different states, there's
Yeah.
some weird rules, and every state's a little different on that one.
Good.
All right, so a good question here. Quickly approaching retirement. I mean, we have 2 non-rental personal use commercial buildings, which represents a large bulk of our retirement. Any ideas on how to structure the sales to avoid major capital gains tax and increased tax bracket other than a 1031 exchange or rent to own?
Well, if it's for personal use, it's really not an investment. It has to be an investment property for it to be eligible for a 1031 exchange. So a couple ideas come to my mind. One is prior to selling the home, convert it back to a commercial use or an investment use. Do it, I'm converting it, I'm trying to sell it, I'm trying to lease it. Run some ads, and but I think the conversion would allow the 1031 exchange. You said they wanted to avoid the 1031.
Yeah, they do not want to do a 1031.
Well, they almost can't at this point
Supposed to.
because it's personal use, is the way I'm understanding it. But a charitable remainder trust, if you donated the property to the charity, and then the charity, I don't have that hat, acting as the trustee acting as the trustee, sells the property. Now that money will go into the trust, of which you get a charitable donation, you get an income stream for life. It can go on to, the second life, so it supports both spouses. It could go on for 10 or 20 years after the second spouse passes away. And if you don't need the money right now, an income stream with the charitable remainder trust could be an attractive way to avoid the capital gain. Other than 1031 exchanges,
Which just kicks it down the road anyway.
right, or hold the property. It really depends on what you want to do with the money. I think it comes to that. If I'm gonna use the money, and I've always wanted to go to Switzerland, and now's the chance to go, or if I want to use it to pay off other debts, I don't know that you can avoid the capital gains tax. I would do it in a year that I could plan my income, so I'm not also subject to the 3.8 excise tax, that came with the Obamacare Act. And know that there's going to be, in most states, there's going to be an additional capital gains tax. This would be one that maybe I could help you with on the hotline, but I really have to know a lot more about what they plan to do with the money to know how to avoid the capital gains tax.
The taxes are going down anyway, right? They're going down. We'll be all right.
Yeah. So with new administration, tax will be down, almost non-existent.
No one believes that, I don't think.
Yeah, I don't
unfortunately.
think so either.
All right, we got about a minute or so left, but Jesse asked a good question here. This is going back to statutory trust and land trust as a disregarded entity. So you get to keep both mortgage interest deductions and capital gain exclusion, even if you live there for 2 years and transfer the home to the trust for another 8 years, correct?
Okay, if we're using a statutory trust and it's a disregarded, now it's important how we choose to tax it, because we could take a statutory trust and choose it to tax it as a C Corp, as an S Corp, a partnership, as a disregarded. I think what Clint was talking about on Friday night, or on Tuesday night, was treating it as a disregarded entity. If a statutory trust is like a single member LLC, if we choose to disregard it for tax purposes, everything flows through and it looks to the IRS as though you own the properties. Therefore, mortgage interest still deductible to you. Capital gains, it's a non-existent entity. Even though the courts see it, the IRS doesn't. They look right through it, and all taxable consequences, good or bad, positive or negative, are going to come down to the owner. If you're the owner of the statutory trust, everything is disregarded down to you. Then mortgage interest is still tax deductible. Capital gains, no difference. because it's disregarded. I think that's what Clint was suggesting on his statutory trusts, is we treat them as disregarded entities. And they're recognized, therefore, by the courts, but not by the IRS, and it doesn't change their tax status.
Kind of cool. Cool strategy
Yeah.
we learned all about on Tuesday night. So, and that's a good point. We do archive these on our YouTube channel. So we can send a link out to you guys. It looks like Troy just put that on our comment section here. So we do archive Lunch with Don here on Facebook and on YouTube. But the recording from Tuesday night with Clint Coons on statutory trusts, really cool strategies.
Yes.
That's on our YouTube channel.
Clint is so brilliant, just absolutely cutting edge. But is it for everyone right now? No. But especially for people that are in California, it was really designed for the strategy he was teaching was really designed for people that are paying high filing fees, not necessarily high taxes, because if you're going to pay taxes, it's not a tax avoidance strategy. It was really a filing fee avoidance strategy more than anything.
Which add up, though, over the years,
Yeah,
for sure.
And it's considered a tax, but
Totally
but
is.
it's very, very different. Yeah.
And especially having multiple entities in one state. Yeah, absolutely. That adds up fast. Should pay for itself pretty fast.
Okay, so we continue to get a lot of questions at the hotline. You're welcome to call as our students, especially those of you that have the asset protection kit, the materials. We answer questions for people that bought the J Mitten kit back in the 70s and 80s and 90s, and the 800 number hasn't changed. We still answer your questions. But right now we're a little busy getting ready for our summit. We really hope that you'll join us on that summit. Kendall, how do they register for the summit if they're not already?
Just go to protectwealth.com.